Roger Stone. We are living in the age of Trump. Historians will look back on 2024 as a change of era like they have for 1932, when Roosevelt's New Deal came in. Currently, did you know that the average American will pay over $525,000 in taxes during their lifetime? That's nearly 35% of every dollar you earn. It's a staggering thought, isn't it? But what if I told you that this number could shift dramatically in 2025? With major tax reforms just around the corner, the rules for how we pay taxes and how much we pay are about to undergo significant changes. Whether you're a homeowner, an investor, or a business owner, these changes will directly impact your wallet. Don't worry though. Today, I'll walk you through 6 key tax changes coming in 2025. Not only will I explain each change, but I'll also break down the exact math behind them so you can see how they'll affect you. Stick with me. Understanding these changes could save you thousands of dollars. 1. Electric Vehicle Tax Credit, Section 30D. The push for electric vehicles is stronger than ever, but starting in 2025, the tax credits for EVs are going to get a lot more complicated. The new critical mineral and domestic assembly thresholds will prorate your EV tax credit based on how much of the car's components are sourced and manufactured in the US. Here's the equation for determining your credit. The amount you can claim is $7,500 multiplied by the domestic content percentage divided by 100. For example, let's say you're purchasing an EV priced at $45,000. If 65% of the car's components are sourced domestically, your tax credit would be calculated as credit equals $7,500 times 65 divided by 100 equals $4,875. While $4,875 sounds like a solid incentive, here's the catch. Cars with lower domestic content will qualify for far less, and those sourced largely overseas might see their credits vanish altogether. Why this matters? On the bright side, this change encourages manufacturers to source materials domestically, potentially creating more American jobs. However, it could also raise the cost of EVs and limit your options, especially if you're considering an international brand. What you should do: if you're planning to buy an EV, research your options thoroughly. Verify if the manufacturer meets these new rules to ensure you're maximizing your tax credit. 2. Capital gains tax increase. If you've been profiting from the stock market, brace yourself. In 2025, the long-term capital gains tax rate is set to increase from 20% to 24%. Including the existing 3.8% net investment income tax. The effective rate jumps from 23.8% to 27.8%. Here's how it breaks down. To calculate your tax liability, you multiply your capital gain by the effective tax rate. Let's say you realize a $1 million capital gain in 2025. In 2024, your tax liability would be $1 million. Times 23.8% equals $238,000. In 2025, that same gain would be taxed at $1 million. Times 27.8% equals $278,000. That's a $40,000 increase in taxes on the same profit. Why this matters? On one hand, the additional revenue supports programs like infrastructure and healthcare. On the other, higher taxes could discourage long-term investments, impacting wealth-building strategies for many Americans. What you should do: if you're a high-income earner, consider realizing gains before 2025 to lock in the lower tax rate. Strategies like tax loss harvesting or contributing to tax-advantaged accounts could help offset this increase. 3. Mortgage interest deduction limits. The popular mortgage interest deduction is about to shrink. In 2025, the cap for deductions will drop from $750,000 to $500,000 for loans originated after the change. Here's the equation for determining your deductible interest. The deductible amount is the lesser of your mortgage principal, or $500,000, multiplied by your interest rate. For example, if you have an $800,000 mortgage at a 5% interest rate, in 2024, your deduction would be 800,000 times 5% equals $37,500. In 2025, it would drop to $25,000. That's a $12,500 reduction in deductible interest. Why this matters? While this change might stabilize the housing market by discouraging overly large loans, it disproportionately affects families in high-cost areas. Reduced incentives for homeownership could make buying a home less appealing. What you should do. If you're considering purchasing a home or refinancing, act before 2025 to lock in the higher deduction limit. Fourth, Roth IRA rule changes, backdoor conversions. The backdoor Roth IRA strategy has been a favorite for high-income earners, but it's on the chopping block. Starting in 2025, these conversions will no longer be tax-free. Here's how you calculate the tax liability for a conversion. The taxable amount is your conversion amount multiplied by your marginal tax rate. For example, if you convert $50,000 to a Roth IRA and you're in the 37% tax bracket, in 2024, the tax owed would be zero under current rules. In 2025, you'd owe $50,000 times 37% equals $18,500. Why this matters? This change ensures that high-income earners pay their fair share, but it eliminates a powerful tool for tax-advantage retirement savings. 5. Child tax credit reduction. The expanded child tax credit is set to revert in 2025, dropping from $3,600 for children under 6 to $2,000 for all qualifying children. For a family with 2 children under 6, the impact is calculated as tax credit reduction equals previous credit minus new credit. So, in 2024, they'd receive 2 times $3,600 equals $7,200. In 2025, that drops to 2 times $2,000 equals $4,000. That's a $3,200 reduction in support. Why this matters? While it reduces federal spending, this rollback disproportionately affects low and middle-income families who rely on these credits for childcare and household expenses. What you should do. Reassess your family budget and explore state-level credits or childcare subsidies to make up for the loss. 6. Corporate tax rate and stock buyback. Excise tax corporate taxes will rise from 21% to 25%, and the stock buyback excise tax will increase from 1% to 4%. For example, if a company buys back $10 billion in stock, in 2024, they'd pay $10 billion times 1% equals $100 million. In 2025, they'll pay $10 billion times 4% equals $400 million. That's an additional $300 million in taxes. Why this matters? These changes aim to encourage companies to reinvest profits into growth rather than buybacks, but they could result in lower returns for investors. What you should do. Watch for companies shifting focus from buybacks to dividends or other shareholder returns. Make sure to like and subscribe. I hope you enjoyed the video. Until next time.